My name is Donald Reed. This is a podcast on investment tips again. So this is what Warren Buffett looks for when he's evaluating businesses. Is the business simple to understand? Does the business have a consistent operating history? Does the business have favorable long-term prospects? Is it a good management? Is management rational? Is management candid with its shareholders? Does management resist the institutional imperative? Okay. Does the company focus on return on equity, not earnings per share? He looks for companies with high profit margins. For every dollar retained, make sure your company has created at least $1 of market value. What is the value of the business? You don't have to be accurate on what the value of the business is. You just have to make an estimate. He said that you don't have to be 100% accurate. I'm taking this from the book called The Warren Buffett Portfolio, and it's focusing on focused investing. So he focuses on these traits, and he makes his decision from these traits on the companies. And it can be low as 3 companies. If you find something you understand, he suggests you invest about 10% of your net worth into it. 10 to 15 companies that have achieved outstanding returns in the past and continue in the future. According to the book, and when I was reading, it says you can pick like 10 to 15 companies, and if you practice focused investing on 10 to 15 companies, you have like an 800% chance of beating the market by focusing just on 15 companies and using focused investing, and leave it there for a good 5 years or longer, 5-10 years. Don't sell them. Here's some more. The certainty in which the long-term economic characteristics of the business can be evaluated. The certainty in which management can be evaluated, both as to its ability to realize the full potential of the business and to wisely employ its cash flow. The certainty in which management can be counted on to channel the rewards from the business to the shareholders rather than to itself. The purchase price of the business. The book also suggested that you will reap better benefits having a low turnover rate than a higher. I think it said like 15 or lower. Learn to think in probabilities. So there was a calculation of probabilities. It was P2 minus 1. So look at 2 probabilities of what you think will happen with the business and do that calculation to minus 1 to get a good insight on what you think will happen with the company. Okay, recognize the psychology of misjudgment. So the psychology maybe behind going with the crowd. Okay, so focused investing is basically going against the crowd. It's going against speculation. So the psychology behind wanting to go with the crowd, maybe that's one of them. That too can be just, ignoring market forecasts. Next one here is waiting for the fat pitch. So if you hear some of Warren Buffett's videos or some of his talks, he says sometimes he doesn't do anything for 2 years. He looks at things and he says he waits for a pitch. So waiting for the right pitch, once you've done your focused investing and you did all your analyzing what you think the company will do, sometimes you have to wait and not hit at everything. By going by all this, do you have a much better chance of becoming successful as an investor and actually becoming rich as an investor? Well, yeah, you do. And I wasn't really going to say something about this because I thought it might, feel kind of... But, I hope this information, if somebody doesn't know the information already, it gets into the hands of some of the poorest people on the planet, because they're the ones that deserve to get this information and to be able to flourish if they have an interest in investing in finance. I'm not saying I'm rich myself, but I'm just saying, the marginalized get treated kind of really badly at times. So I think it would be good that it would get into the hands of the poor and the marginalized so they could change their lives. Anyways, this is Donald Reed. This is Investing Tips, and that's it for now.